The original filing range for Lyft was in the 60s, and they ended up pricing the IPO at 72. The stock was volatile shortly thereafter and has sort of, come under some pressure. That's very much not unusual for these tech IPOs. I think investors will get the first look at Lyft's actual fundamental performance today, and I do think it'll be solid. It really shouldn't come as a huge surprise because a lot of the stuff that was happening during the quarter they were talking about already as they were going through the IPO process.
But still putting it out there in black and white, Deirdre, has been. And what are they expecting, roughly speaking? I know the estimates are hard at this stage of the game, but in terms of, I was going to say earnings, but let's say losses. Presumably in revenue.
Well, it's interesting. There shouldn't be any surprises. There shouldn't have been any surprises all along, yet there have been. You see it priced at a certain amount and then fall back from that, from 20% from its peak. So in terms of losses, we're expecting more of the same, just like we saw from Uber for its first quarter. Losses in the ballpark of $270 million adjusted. That's on par with what we saw last year that we already know investors haven't really responded that well to. So that's what I wonder. Will they be able to look past those losses and maybe not take that as a surprise this quarter and look at things like contribution margin, active riders, what's happening with the drivers? We'll see. I'm not too optimistic given what we've seen in the last
Michael,
few
you
weeks.
have a $75 price target. So what do you think that implies for, when do you think they get to earnings? What does that mean for revenue multiples?
So we have a $75 price target. It's based on 6 times revenue. It's backed up with a DCF model. The reason why we're focused on impartially a revenue multiple is because the company won't turn profitable in our model until 2023, give or take. And
give or take.
The reason
4 years
for that,
from now, give or take.
And the reason for that is it's very much a land grab here in the United States where Lyft operates right now. We think that only 2% of all passenger miles are currently being traveled on these shared transportation networks like Lyft. And we think that's going to go a lot higher. I mean, one of the really...
Right, but is it going higher in a profitable way? I mean, and also one of the criticisms about Uber's filing, Deirdre, as the IPO looms, is that investors aren't getting enough clarity on the stuff that really matters. Break out Uber Eats for us from just the ride-sharing business. Help us compare it apples to apples with Lyft, because you mentioned that these are adjusted losses and adjusted revenue. You can't even look at these two sister companies and get a clear sense of their financials, one compared to the other.
You're right, and I think we know a little bit more about Lyft because it has gone public. We get these quarterly earnings, and it's a pure play in ride-sharing, right? Uber has all these other businesses, and there were very, very few details in the S1. We don't know really a whole lot about its Eats business because it's grouped in with ride-sharing. We know really nothing about its last mile business, scooters and e-bikes. So I think what we see from Lyft, I wouldn't be surprised if it raises a lot of questions about Uber at a critical time, just days before it's expected to go public.